Hi, and welcome to EEI's financial series on banking and investing. You're now watching part one of the series. To understand banking, we're going to start by talking about money and why it was created. The pioneering use of paper money is widely credited to the Chinese, who used it around 650 AD. Asking who invented paper money will also inevitably lead to another important question: why? The use of paper money began when people decided to deposit their large sums of money, which were all in coins, into vaults owned by enterprising individuals who made a profit safeguarding other people's riches. In return, the depositors got promissory notes from these individuals indicating the amount of money they left in the vaults. These promissory notes then became the first paper money, as they were later used as a form of currency, since the promissory notes themselves can be used for trade with other people. Money is something that we have at our disposal, which we use to maximize the value of our time, labor, and household if properly budgeted. Furthermore, we can use money to generate wealth and prosperity for us and our families in the long run. Money's most important function is as a medium of exchange to facilitate transactions. Without money, all transactions would have to be conducted by barter, which involves direct exchange of one good or service for another. Rather than bartering, money functions as a unit of account, providing a common measure of the value of goods and services being exchanged. In order to be a medium of exchange, money must hold its value over time. That is, it must be a store of value. Now we're going to discuss our current banking system. Banking works in the same manner that it worked back in 650 AD with the Chinese. People find a bank and entrust their money to the bank to keep it safe. The bank turns around and gives it to someone else in order to make money for itself. Banks can legally extend considerably more credit than they have cash. So how do banks make money? Banks make money by lending money out at high rates for projects and investments and paying back savers at lower rates. If banks lend out more money than they have in cash, how do they stay secure? The answer lies in central banking. When all the banks put their gold into one central bank, it solves the following problems. It makes sure reserve ratios are consistent. It provides one bank issuing currency, as well as provides bank regulation. The Federal Reserve System, also known as the Federal Reserve and informally as the Fed, is the central banking system of the United States. Its main functions include setting interest rates, controlling the money supply, buying and selling treasuries, regulating other banks. There are 12 regional banks located nationwide. Our current banking system relies on a concept called fractional reserves. Under this concept, a bank must maintain legally required reserves in the form of vault cash and/or balances at its Federal Reserve Bank equal to a prescribed percentage of its deposits. Current regulations reserve requirement is 10%. This is a fraction of the actual cash and other liquid deposits. The remaining 90% can be used to create new money. In this example, Bank A receives a deposit of 100 units. Under federal regulation, the bank must reserve 10% or 10 units of that deposit. It is then free to loan out 90% or 90 of the units. Other banks then get that 90% and then are legally required to deposit 10% or 9 units. From that 90%, they are allowed to loan out 81 units. In this example, what started out as 100 units of money deposited becomes 171 units of money loaned. Banks also make money by offering these basic services: checking accounts, savings accounts, loans, debit cards, credit cards, and CDs. It is important to note that there are alternatives to your traditional bank. Credit unions, money market mutual funds, and cash management accounts all serve as alternatives. Now that you know a little bit more about banking, stay tuned for part 2, where we talk about ways in which you can spend and invest your money.